Welcome to Inside the Margins, where we look at how risk is measured, priced, and managed in global financial institutions, fintechs, and banks around the world. Today's guest is Richard Branco, Head of Risk Management Solutions at Climcycle. Richard works directly with banks to connect ESG and climate risk to credit risk, portfolio risk, losses, and capital allocation. In this conversation, we'll move from ESG as a reporting obligation to ESG as a financial decision driver. We'll cover quantification, stress testing, what portfolio resilience really means in practice. I'm your host, Matt Komos, founder and CEO of Ogma Risk and Analytics. Richard, welcome and thanks for joining us.
Thank you, Matt. Thanks for having me.
It's our pleasure. And before we kind of dive into some of the technical stuff, let's talk a bit about what ESG is for those that might not be familiar, and a little bit about your background and how you happened upon this area of practice for risk management.
Yeah, so ESG is environmental, social, and governance risk. So everything related to environmental, so transitional and physical climate risks, and social and governance risks, or just social and governance. How did I ended up here? So originally I started my career in like the classical credit risk. So I started at a specialized bank, specialized for infrastructure investment in the credit risk management, and later I started at KPMG, where I did stuff around credit risk management again, mostly around IFRS 9 credit impairment models. And at KPMG we started with the topic ESG, so also Climcycle started there. And now for already 3 years, we are a standalone company, and I have the pleasure to be responsible for our risk management solutions.
That's great. I look forward to hearing a bit about how, because my background is much more in that traditional credit risk, but we're seeing more and more that ESG is becoming top of mind for a lot of risk professionals. And I think until now, maybe many banks have kind of viewed this as a compliance requirement, but I think that we're starting to see this shift when we see ESG impacts repayment and collateral, right? So, when a bank first engages with you all at Climcycle, what are some misconceptions, or maybe the biggest misconception about how ESG actually affects credit risk? And how do you as the kind of consultant or expert kind of shift that mindset, right? That thinking.
Mm-hmm. I mean, one of the biggest misconceptions I see is that banks say, okay, those risks are insured and we don't have this risk. But this is a misconception, because the time frame of a bank and of an insurance is completely different. So for the insurance, they can terminate the insurance policy every year. So if the risk rises, they can increase the premium and in the end just terminate the contract. But the bank has this loan on its books for like also 30 years, 40 years. So they have the risk. And this insured risk isn't really insured. So they should be aware of the risk and manage the risk.
Yeah, and I would imagine, right, that on that point, there's probably a shortfall on the insurance, when you compare the insurance and the collateral value, right? Sometimes that adds to the risk.
Yes. And also you can already see it that there are areas in the world where you cannot insure certain risks. As an example, flood risks. You cannot insure flood risk in the North Germany in some areas. I think also in Florida, it's not possible to insure hurricanes. So we really have an issue here, and banks should be aware of it.
Yeah, those are some great points. And when we talked previously, you talked about two different kind of potential damage channels, right? Which is repayment ability and collateral value. So could you walk through a real example and, maybe explain at a high level what repayment ability and collateral value refer to when we think about climate risk, and then, where those are both affected at the same time?
Yeah. So first of all start with what does repayment ability and collateral mean. So we have two aspects. So we have like the probability that the loan isn't repaid, and then we have like the amount of money that we will lose when it's not repaid. The ability to repay, or let's come to the example. So let's have a look into you lend money to a company. The company produces something, so they have a factory, and the factory is flooded. So there's a flood event. First of all, you have damages on the building, meaning that maybe you have this building as a collateral, then of course the collateral isn't worth so much as you thought to be. So the expected value of the collateral is lower, meaning that if the loan will default, you will lose more money. The other aspect, the ability to repay, is that the factory cannot produce during when it's flooded. So you will lose your revenue, and the company will not be able to like repay the loan, or the probability that they will repay is lower. So those are the two risk channels we are looking at.
Yeah, and so it just in your description there, it to me brings some level of complexity that maybe more traditional risk managers haven't really thought about, at this point. And given that, do you think when we think about ESG risk, does it make sense to embed into existing credit frameworks, or is it a standalone assessment? And how do you think about that?
Yeah, you should embed it. So at least in Europe, it's also the expectation from the banking authorities. So ESG isn't like an individual risk class, but should be integrated in all the other risks. So in credit risk, liquidity risk, so on and so forth. So I myself, I'm very focused on the credit risk. So I will also focus here in this podcast on that. So you should embed it from like the expectations of the banking authorities, but it also makes sense because one of the biggest issues banks have is the data availability. And if you embed ESG in like the loan origination process, so from the beginning, you really can collect the data that you need during the loan origination, and this enables you to later to steer and mitigate risks. So it should be one embedded process. Of course, there are many ways to do so. But I think the best way is to really bring this in the conversation with the client of the bank.
Yeah, and you raise a really important point with regard to data, and I think as risk professionals, something we're always thinking about is how do we ensure we capture all the right data, right? Any projects that we engage on, it's, do you have the data we need available? And if not, how do we ensure we can go capture it? We'll touch on that, in a little bit, in a little bit more detail. But I think, so when we think about, let's identify ESG as truly is a component of credit risk. The next challenge is, okay, I can identify it as a risk, but then how do I shift that into financial numbers or financial measurement, right? And so, if you think about credit scoring, right? Credit scoring is pretty useful in many contexts, right? As you mentioned, you come from a more traditional credit risk background, as do I, and we build scores, models all the time, evaluating maybe consumer risk or small business risk. And a key component, obviously, is that pricing that risk helps drive decisions, right? And I'd love to hear a bit about, if you were engaging with a client or you kind of had a moment which helped you realize that scoring alone wasn't enough, right? And that you had to really quantify the impacts of ESG because, I mean, at the end of the day, as risk professionals, we think about, how do I get comfortable with being uncomfortable, right? And part of being uncomfortable is quantifying what those outcomes might look like. So we'd love to hear a bit about your perspective on that.
Yeah, I think there are two motions here. First one is that also the banking authority wants banks, at least in Europe, to quantify the risks. So this is really an expectation. Second thing, I think it's like the logically evolutionary stage here, because I think the risk identification is more or less very well established in banks. So of course this identification differs in quality maybe, but most of the banks have something in place here. And now the logical next step is to quantify those risks in order to really be able to do something about it. And why I don't want banks to do that? So many channels here. First one, it's I think a very strategic number to know because of course you can optimize your capital requirements. On the other hand, it also enables you to upsell on your clients. So you can sell your clients new loans, new products in order to make them transist to more carbon-free world or to mitigate physical climate risk. So those are the two aspects I think that are most important for banks right now.
That's interesting. So you're saying, for example, a bank might be more willing to provide a specific type of loan if there's a reduction in, say, carbon footprint based on the type of product the consumer's getting.
Yes, might be because in the end, yeah, they want to like minimize the capital requirements. So it's better to have
Yeah.
a loan that's not as risky as another loan might be, and of course also you, as I said, you can sell something to your clients, something additional, because also for the client, there might be a sweet spot where they, as example, renovate their home, increase the energy efficiency, so they save money each month for energy costs. So you can grant them more money, and you increase your portfolio.
Oh, that's some great insight because I'm not sure that in the US we're kind of incorporating that just yet. I think there's probably opportunity to do so. And I think, with this shift of ESG as kind of maybe that compliance requirement previously to actually becoming part of a risk framework, I think we'll start seeing more and more folks move to it. But it raises a question about, and we started touching on this a little while ago, but data is important to this equation, right? I think we can all agree that good data and actionable data provides insights and allows us to assess things correctly. And so in the case of, maybe climate or just in general ESG, how do you handle, if you're missing granular information, if you're working in emerging markets, kind of what's your approach when you're thinking about how to fill in those gaps?
So our approach here is that whenever it's needed, we have some sort of fallback values, so based on like industry, country averages, and on approximations. So of course, in the end, the result will not be as granular as it could be, but you have something and you can start with something, and then we help the client to improve the data situation, because this is something that you can improve, maybe not for your legacy portfolio, but you can start for like new lendings, for loan origination, to collect additional data, because for the legacy portfolio, you might not be able to get something from your clients. They are not obligated to do so, but for the newly originated loans, you can do it. And yeah, here we provide some like structured way to do it, to collect the data and to collect the important relevant data.
Okay, so it's like part of your software solution and the services you provide, you can help set up that data collection process.
Yes, correct. And also what we also do, of course, we have like an internal database, mainly for companies, of course, where we collect reported ESG data on our own, and then our clients can just call that data from that database. So we also help here closing those gaps with already collected data.
Okay, that's great because again, it's a very common practice in consumer credit, right? Or small business credit, where you have kind of that archived historical data, which allows you to do retro analyses or build models or scores. And so it sounds like you then basically unlock that capability to kind of say, okay, had I, had this information 6 months ago, would I have made different risk decisions? Is that correct?
Yeah, correct. Yeah.
Yeah, so I would think with ESG considerations, there's a component of macroeconomic effects, right? So obviously the macroeconomy will play a part, and we use this a lot in stress testing in kind of understanding a loan portfolio. But in the ESG, when you think about macroeconomic effects, the borrower level impacts, right? How do you prevent double counting, or how do you approach incorporating those type of things into your stress testing? And again, we do it traditionally in consumer credit, but I'm curious if it shifts when you have this ESG focus.
Yeah, what we do is that we calculate each and every effect on their own. So you get like the microeconomic effect, you get the macroeconomic effect. You also get like if there is an interaction term, you get that effect, and so you really can distinguish okay which effect comes from which, and so you can adjust those double countings very easy. So it's transparent what happens and what are the results here, and yeah, I think that this is what we definitely doing. We are now very focused on the macro effects, so we also have the macro effects, but this is something that we will really tackle this year in our development to improve this further.
So yeah, it really sounds like you guys can provide kind of a robust perspective on maybe data that hadn't been available for the client. You provide good stress testing capabilities with macroeconomic information, right? These are all features that I think are important in any kind of solution that you contemplate, right, as a risk professional. Um, and it ultimately, right, it gets to the point we were initially making, which is I can now quantify the financial impact of the risk, right? I have to have that data. I have to be able to stress test and do macroeconomic scenarios, and that gets me to, what is the potential financial impact? And I think once we've established that, right, the next complexity is scale, right? Is how so let's say I'm a multinational, right, or I'm a global institution. I might be interested, not just in kind of the ESG effects in one region, but potentially five regions, right? Kind of shifting to that thought process about, okay, now that I've established, I can do some great things within one region. How do we start thinking about going across geographies, right? Because to me, this is, universe expansion is something we often think about in consumer credit. And I'm curious if, some of the same lessons, like a specific model that might work great in one market doesn't work great in another. So when you go into a new geography, kind of what's your go, no go framework, and what data gaps can potentially make a market too difficult to serve?
hmm So, I mean, I would say, general approach is to be here globally available. Of course, the data quality differs in different countries. So, here in Europe, we have relatively good data quality. If you're looking at like in emerging markets, as an example, the data quality, yeah, differs a little bit. But what we do here is that we incorporate like local data sources. So of course we have to do research here. We have to check on the data quality of these local sources. We have to check how we have to transform the data, but then bring the data in our framework in order to help our client in that additional country better. So in general, we can help them from the start, but we will also work with them to find here like the best possible additional data sources here and integrate it as.
Yeah, so you're relying somewhat on kind of that local knowledge of the client you're serving to help inform, the approach, which again, I think it's a common, challenge that anytime you go into new geographies, you have to be cognizant of. And, when we think about developed countries, emerging markets, they present different challenges, right? And as you point out, whether it's the alternative data that's available, maybe the granular level of, the debtor information, whatever those cases might be. Thinking about it from an ESG perspective, what have been some of like the biggest surprises you've come across because you've worked in developed markets a lot, and then as you all expand into those emerging markets, what are some like learnings and surprises that you've come across?
Yes, something that really surprised me was like the effect that European regulation has on other geographies. So when I'm talking with banks in like countries in Middle Asia, they are very, very oriented towards the European regulation. So because in those countries often you don't have much regulation or no regulation at all, but those banks, they are really focused on what happens in Europe, and
Hmm.
they do things without having like the obligation in their country. So this was something that was really surprising to me, because I think like the public discussion often says that, like, okay, in Europe we have too much regulation, and this regulation really kills our competitiveness. Maybe in some aspects it's true, but on the other side we also have like this uh, positive effect on other regions here, because I think like the risk management isn't something that should be not only be regulatory required, but it really helps you, because risk management helps you to mitigate losses that you want to have.
Yeah, it's good business practice, right? I mean, that's at the end of the day. Um, I think when I think that is a great indication that other regions, other countries, even though to your point, and in the US, we sometimes have that view of, oh, it feels like the regulation is heavy in Europe. But the fact that other countries are looking toward what you are doing, I think actually speaks volumes about, kind of the success of having that framework in place. And as we kind of alluded to, it's just good business practice, right?
Yes.
Yeah. And I think if you think about the concept of bringing these frameworks and the ability to incorporate an embedded ESG program within a greater risk management framework, right? As our models scale, I feel like that, kind of the real value starts to appear when we can shape future strategy, when it can help us make good business decisions, kind of to that point of lenders that are utilizing these frameworks that maybe don't have to. And so now, I can get from not just measuring risk and understanding how it affects my portfolio, but I can drive strategy forward. I might, think about going into a whole different type of product category because I've incorporated the ESG risk, right? Um, and it kind of touches on what we were just talking about in terms of stress testing, right? Um, to me, a lot of like the importance or kind of the um, where stress testing can matter is if it really informs your lending and portfolio decisions, right? And when you're working with clients and kind of presenting these different scenarios, you know, what do you find that the clients find most actionable, right? Like the physical climate pathways, transition and policy scenarios, some combination of both, where it is helping to drive strategic direction of a business. I'd love to hear some of that insight.
Yeah, I think that the focus is more like on the transitional part, so that they really think about, as I said, so there is the possibility to really foster the transition for you. You lend more money to your existing clients in order to make them more carbon neutral, as an example, to renovate their home, to change the machinery that they are using. So I think this is like the more actionable thing. Um, of course, not only, but that's the focus in my experience, at least.
So, and if you think about that, right, a component of kind of the stress testing, right, as you think about those transitory kind of scenarios, there are a lot of components from a regulatory standpoint, right? So when you're thinking about that stress testing, what do you think is missing today? And do you help provide some of that guidance to your clients? So, if you think about, okay, here's what we think about from a regulatory standpoint, but as Climcycle and as experts in this area, what are things that you think are missing and could be improved on?
Mhm. Yeah, I think that the regulatory stress tests, they are very like from that portfolio's perspective. So they're really looking at like the whole picture. But what's a little bit missing for like influencing your lending process is like the macro perspectives to really look on the single engagement, the single loan, and to see what really matters to that loan, to use individual data here to do individual assessment and really know, okay, what will happen with that specific thing, not in general, not for the whole sector, but really with that individual company or individual private person.
Yeah, and I feel like we have often come across challenges with some of that macroeconomic forecasting and estimation where um, you know, people don't always interconnect those scenarios, right? So ensuring, for example, that if interest rates fall, that what that kind of full flow through effect means, in terms of cost of capital and how it impacts capital allocation, and ultimately, right, what macroeconomic factors are intertwined that impact some of those ESG, perspectives, right? Um, Based on what some of those macroeconomic assumptions are, right? How do you help institutions understand, if their portfolio, the modeled losses are realistic or not, right? Because obviously underlying that ability to do forecasting and loss provisioning, there are some macroeconomic assumptions. So how do you, get clients comfortable with the fact that, yeah, this modeled outcome is real?
hmm I mean, one problem that we have here, especially in like the climate change environment, is that things are changing in the future, and of course, this makes backtesting a little bit hard.
Sure.
But this is what we do. So we backtest what we calculate. So we offer to our clients, okay, you use our software. If you want, you can share with us your default history, and we do a backtesting here with pooled data from many banks, from banks in various countries. We really backtest it, and you get results here. And this, of course, helps to build credibility here. And yeah, I think that this is the like most important thing that we do here.
Yeah, that's really good. It helps kind of provide the right framework to be able to do that back testing. And I mean, back testing is obviously very important for forecasting and, testing different assumptions and stressing kind of a new strategy, right? So that's great to hear that you kind of provide that, that right framework for folks to get comfortable with kind of those modeled losses. Now, thinking about, um, where do you see ESG going, right? So as we're looking to close up, I'd love to hear kind of your perspective on, the direction that ESG risk management is heading, and what are some of the mistakes that banks are making today when they integrate ESG and climate risk into their credit decisions, and how do you mitigate that?
Yeah, I think that ESG will like shift from that regulatory necessity towards a really strategic asset that a bank has, um, in order to be really more competitive than their competitors. Because with better risk management, you know your risk better, and you will in the end you will increase your profit with that. Some mistakes that banks are doing is that they think not in a holistic way about ESG, because ESG, it's not only important for like the risk management, but you also need this as an example for reporting. Also, reporting is very important because investors, many investors, they really look at the numbers. They want to know, okay, how sustainable are you? Should I invest here? So your reporting is also important, and this should be like an integrated thing that you're doing. So there should be one database, and this database is then used for everything, for risk management, for reporting, for all like the options that you do with in that area. And yeah, this is what we're doing for banks with Climcycle. So we give them one single source of truth, so to say, to enable them to do sufficient risk management, sufficient reporting, and all the other stuff as well.
Well, I'll tell you, Richard, you've helped open my eyes to a lot of new learnings about ESG risk, how we need to be thinking about it as risk practitioners. I really appreciate you joining the podcast, and I hope all of you watching enjoyed this perspective. Thanks again, Richard Branco from Climcycle.
Thank you very much.
All right.